Hello everyone, welcome to another webinar from Alpha over Beta. My name is Alon and we're going to talk today about typical market behavior. So topics that we're going to cover are what's a typical price move for market and what's not. What are corrections and how significant are they? Support and resistance, we're going to dive into those and explain those in details, and much more. So disclaimer first, Alpha over Beta is an online service. It's an online investing service. We present data, quotes, charts. This is definitely a lot of information, but you should consider your own risk and customize the risk to your own risk investing style. About me. My name is Alon, as I said, and I'm the founder of Alpha over Beta. I've been trading the US market since 2005. I lecture on trading the US stock markets, and I've mentored many students on their way to becoming a successful traders. And I lead the research and trading team, which is focused mainly on long-term portfolio investment with low risk and high return on investment. Okay, so let's start. Let's start by looking at a chart of the daily graph of the S&P 500. Let's look at last year's action. This is price action that is really typical of the market. Now, as you can see, the market does not move up or down. If we can just scroll this, you can see that the market does not move up or down in a straight line. This is very typical of the market, and it's a good thing. It's a good thing. We don't want the market to move up or down. Just a minute, let me draw a line here to emphasize the down move. So this is a down move, okay? So we don't want the market to fly up or down in a straight line. We can all see that typical market behavior really is a series of up moves and then a smaller series of down moves. Like if you can see here, let's just zoom in on the up move that started in 2019. If you can see, during this uptrend, we did have some up moves, and then what we had is some down moves, and after that we got some more up moves. Let's paint those green, and some down moves. Let's take that here, some down moves as well. So typical market behavior really is a series of up moves and then a down move. Now that down move does really retrace some of the up move, as you can see here, and this is called a correction. A correction is a move that is in contrast to the major move. Now the major move here is an up move, and then the correction comes in the opposite direction. It retraces some of the up move, but not all of it. Sometimes it even stays at the same price for a number of days. So a typical market behavior is not moving all the way up in each and every day or week or whatever bar you're looking at the chart. A typical market move is an up move, which is constructed from a number of bars that create that up climbing up on the price scale, and then at a certain point you get some retracement, and then you get another number of bars which climb the price move, and then you get a retracement. Now the retracement is not entirely the entire up move or whatever that preceded it. It's just some of it. Sometimes it's a third of the up move. We're going to talk about what are the significant percentages for a correction. But a typical healthy up move or down move is constructed of these corrections. Now these corrections usually mean that the movement to the up or down This time we took the S&P 500, so we took a move to the upside. Now this means that the move to the upside is a healthy move. We should be getting those corrections. Now sometimes these corrections, like you can see here, lasted for almost a week or maybe even more if you consider those bars as well. So you see this, it's like a, I don't know, a 5-10 bars move with respect to the upper price, and it retraced some of it. This is why we should be patient with the market and understand that corrections are healthy. They should be a part of the market movement, and if the market moves to the upside, then we should expect some correction to the downside. Now, if we can see an uptrend is constructed from these up moves and the corrections. As long as the corrections occur and we can spot them each and every time in a higher price scale, we can say that we have an uptrend on our hands. Now let's look at the May move. Once the downtrend that is more significant than a correction, and we're going to talk about that. This is a strong correction, okay? This is not a light correction as we saw all the way up to May. No, on May we started to see a really significant move to the downside. So if we retrace a lot of the previous up move, okay, let's mark that, say that this is the move to the upside. If we retrace a lot of the movement to the upside with the movement in the opposite direction, we can definitely see that this is not a correction, or maybe it is a strong correction, and we should consider it differently. So what we say is that the market is not shooting up or down in the straight line, and corrections are healthy and we should look for them. Actually, corrections are an opportunity. They are an opportunity to get in on an uptrend, get in a good and less expensive price than the market was previously at. So if you have a correction on your hand, and you can see that generally we have an uptrend, okay, let's take that line here and just this point all the way up. So this is an uptrend. Now once you have in an uptrend, you have this correction, the market gives you an opportunity to enter at a lower price. And what happens if you enter in a lower price and the market significantly goes to the downside? This is when money management comes in, and you should lower your position. You should just decrease and reduce your position to a position that you can absolutely manage. All right, so corrections are good. They're part of an uptrend. They're part of a downtrend too, and we should look for those, and they really give us an opportunity to go in on a lower price. Okay, now there is a calculation that we can make to see. Let me just erase those lines here so they won't clutter the chart. Okay, how do we know if we have a correction, a light correction, a strong correction? How do we know where we stand? Well, we can use a calculation called Fibonacci, and I'll show you in a minute how to use that. And Fibonacci basically means the Fibonacci calculation shows you where the potential places for a corrections are and how you should look at that correction. And what do I mean? Let's take a Fibonacci retracement tool we selected from here. Okay, and we in an up move, in an uptrend, we select the lower point and we go all the way up. Let's select this upper point here and see if what can we make of it. Now the first retracement in Fibonacci is the 28.6%, which for this uptrend positions the first correction at a level of 270.5. Let's round that up, 270.5. So we can say that as long as the uptrend continues and we have a price range that the lower point of it is 270.5, we can consider this to be a correction and not a beginning of a downtrend. So we can calculate our risk this way and see where the price is with relation to our risk investment style. How do we know this week? Look at this week. This week has a number of significant red bars. You can imagine that being a Monday, red, Tuesday, red, Wednesday, red, and on and on. So you start to think, where do I stand? Where is it gonna stop? This is where Fibonacci comes in. I'm not going to explain Fibonacci in a deep and detailed manner. If you want me to have a webinar which explains Fibonacci and its importance, its origin, where does it come from, and how can we use it to calculate risk, just comment on this webinar, and I will consider making another video explaining Fibonacci. But for now, what you can see is that the first level of 270.5 is really the level at which we can say, and if the market does not drop below 270.5, I am in a correction. So you can calculate your risk and say that the minimum level of price that you will consider to maybe reduce your position, maybe close your position, is 270.5. Until that level, we're cool and okay. Let's continue with that example of Fibonacci and take it all the way up here. This is the maximum point. Okay, so what we see right now is that this uptrend gave a level of 280, about 280. And you can see that 280 was here resistance, which served as support, and the market really bounced up from that support. Here it is as support again. Here it is. It was broken. Okay, so the 280 is an important level. So we can say regarding this uptrend that reached all the way to 295, we can say that if we are above and the price is above 280, we are in correction mode. And we were in correction mode for a long time until this drop. Now, what's the next level mean? The next level means that we have another level of correction, or maybe we should reduce our position in that level. We're going to manage our risk according to the Fibonacci levels. Why? Because the Fibonacci levels signal how significant is the retracement. So a retracement until 280 is not such an important correction. But if we drop all the way to 270, 271, then this means that we are in a strong correction, maybe the beginning of a downturn. So I would keep my whole position until 280, until we reach 280. And once we broke 280 here, let me just mark the place where we broke 280. Okay, so here is the place where we broke 280. Okay, so if we break 280 here, we have a really significant correction and maybe a beginning of a downturn on our hand. And what we should do is reduce the position. Now the same level can be used again once we cross it to the upside. Let me use the same just to show you the level again. Okay, so this level of 280 was broken again to the upside. Once it's broken to the upside, we can increase our position, and this way we manage our risk. We reduce the risk once we see that the price goes against us, where on the Fibonacci level points, and we use the same level points once the price goes up to increase our position and continue enjoying the uptrend. Okay, so this was a light explanation really of Fibonacci and how to use it as a risk calculator. Again, if you want a detailed description of that, comment on the webinar and we can have that. All right, I would like to show you a typical down move and a typical up move. Look at this down move here. Let me just remove Fibonacci so it won't clutter the chart. All right, and those arrows again. So if you can see here the down move we had at the end of 2018, look how violent the down move is. Down moves are a lot quicker. They move faster and with higher volume. Let me just zoom in so you can see the volume. You see the volume here? The volume during the down move really increases, and that's because down moves are mostly a panic move. This is where traders and speculators sell what they have just because other people sell, and not for a real fundamental reason. If there was, there would be a really down move that is constructed of corrections. But once you see this really violent move from the 280, as we spoke before, the 280 all the way down to the when did it end? 234, 235. As you can see, with an increasing volume, this is really a typical down move, which is much faster and more violent than really the up move. Look at the up move that followed. Okay, the up move that followed, the uptrend that followed. This one took like from, when was it? The beginning of December to the end of December, about 3 weeks, and then it started towards the end of December, and reaching the same level took us about 2 months. So an up move really is slower and constructed really from corrections, but during a down move you can see that the downtrend really is constructive of mainly of red bars. All right, so you should be careful with a downtrend. Be very nimble on a downtrend and be very fast to reduce your position, and then increase it once you see that the up move is really healthy. Okay, I would like to take another look again because we just had another one of those. Last week or the week before that was a really violent move to the downside. Here you can see the volume increasing on the down move to the downside. This took like a week or so to take the price from the 302 all the way down to, guess where? 280. Okay, so we have a down. It's not a trend, it's really a meltdown, if you want, for a week. So really downturns are really more significant, they're faster, they have a lot higher volume, and as we said before, if you can see that the red bars are increasing, you can use Fibonacci like I used before. Let's do that again just to show you where the levels are. So Fibonacci, I will choose Fibonacci from here. Let's take the lower point, take it all the way up to the maximum point of that era, of that time period, and then we can see that the first level we should have reduced our position was 295. 295 was the first level that we should have reduced our position. Now we stopped on the 285, 280, 285, and then once climbing back, the 288 is the first point of increasing our position, and so on. Okay, so there's a difference between an up move and a down move. Okay, the market has a saying that the price takes the stairs to climb up, but takes the elevator to go down. This is because, as we said, down moves are more violent, they're faster, and they usually are constructed of a higher and higher volume. Okay, so that's the difference between the two. What I would like to show right now is support and resistance. Now again, we're going to just use support and resistance. Let me just remove that, just as an explanation of typical market behavior. Traders like to buy and sell in the same price levels. What do I mean by that? I mean that if I will take an example of the end of 2018, you can see that I can somehow mark this reference price here at the 265, and then again I can do that again. Let me clone that and mark here the price of, guess where, 280, right? We can use that to explain a number of buying and selling pressure levels. Okay, so support is where the price meets a certain level and then bounce up, and resistance is where the price meets a certain level and then moves down. So we do have support and resistance level wherever we look in the market, and we can definitely find those in here. Let me just, it doesn't have to be in the same time period as we saw before. Okay, so let's look at the 280. Now that's really not exact science, and 280 is not 280.11035. You get my drift. It's a zone, it's an area of the 280. It can be 275, it can be 285, but it's an area. It's not an exact determined price level. So the 280 is used as some sort of support. It was broken here, which is a bearish sign, and it was broken to the upside here, which is a bullish sign. And we can use support and resistance to significantly use them as risk point of increase or reduce our position. So that's the significance of support and resistance. Again, if you want a detailed explanation about support and resistance, we can do a whole webinar on those. Just comment on this webinar and we'll definitely consider doing a whole webinar on support and resistance, explaining the logic of the buyers and the sellers behind the story of the support and resistance. Okay, so to conclude this webinar, we've seen our typical market behavior. We see the term called corrections. We saw how to use Fibonacci for risk management and support and resistance for risk management. We saw how to relate that to volume and to manage risk for our own. So I would like to thank you for taking the time to watch this webinar. As always, I would appreciate any comments, and you can send them to me at alon@alphaoverbeta.net. Thank you again, and see you in the next webinar.